let us examine an important phenomenon that happens in the stock market. This phenomenon happens when it makes sense to buy when risk is high and sell when risk is low. This is strange but true. This is true because risk factors are not permanent. This section details more about this phenomenon. The phenomenon is examined by examining the goal of the investor. The goal of investing is to sell something at a price that is higher than what you have paid for it. The problem that you as an investor face here, which is the most important point, is determining when prices are low enough to indicate a buy and when prices are high enough to decide that selling is the best choice. An effective tool to determine the good time to buy a stock and a good time when to sell the stock. This effective tool is the long-term trend line. What we need to do here is to interpret the long-term trend line and to make accurate decisions and to book profits. To interpret the long-term trend line, take a long-term price chart, say 3 years or 5 years. Then you can draw a pattern of the price and mean price. There will be certain patterns and movements of the prices and mean prices. From here you notice the lowest point that the stock has reached, which is the minimum price. Then next notice the highest point, which is the maximum price of the stock. Now between these 2 years draw a rough trend line, and next time that the oscillation occurs, you can predict with fair accuracy when the price will return to normal and which direction the price is going to move. And this is a very important information. If you know that the prices are going to rise, you can buy the stock, and if you feel that the prices have become maximum and that it is going to drop, that will be a good time to sell the stock. The trend line helps to define the time when the prices are moving and the direction, either going up to the peak or going down to the trough. The trend line is a useful tool to identify the direction of the stock prices. You will be selling your stock once you identify that the prices have reached a peak, for you know for sure that according to the trend line the prices will fall. Similarly, you will be buying the stock once you identify that the prices have or are going to trough or reach the minimum, for you know that according to the trend line the prices will rise. What you need to do now is to project the same trend line for this year and for the future by just extending the line in the same angle. The trend line can help you identify the expected movement of the stock prices, and you can draw a conservative peak, which is the maximum, and trough, which is the minimum estimates. Now you can select the time to buy and when to sell. There is a surprising analysis that comes up here and which is so important. When you examine the trend lines, you will know that there are some cyclical patterns observed. So a stock has a good run up and after that you might have found that it is going down. So if a stock has a good run up, that might be a time to sell, not buy, because according to the past trends, it is time that the stock prices, that price is going to drop. On the other hand, you might notice that according to the trend line, when the stock prices have reached a minimum, then time and again in the past, it has picked up and gone up. So similarly, if a stock has dropped like a rock, it might be a good time to buy rather than sell it, especially for undervalued stocks. In other words, you can buy low. An important point to note when you buy low is that there might be a negative momentum going on in a market for some time, and so you should be prepared for paper losses. You will not be booking the losses, but you might notice that there are some paper losses appearing for some time before the momentum picks up and you can look for profits.